Hello, welcome to the webinar. This is professional investor and developer David Campbell, and it's my pleasure to be on this call today with a very esteemed faculty. We've got a lot of great information for you, and I really encourage you at this point just to clear out the distractions that are around you. It's very easy to check your email during a presentation. When it's a live event, you get full participation, full out. But when it's a webinar, it's easy to just put this in the background, and I encourage you, if you're going to invest the time to be here, really play full out. Get your mind focused and get the distractions to a minimum. And let's get started. A lot of great content today. So the first thing is a little bit about myself. I'm a real estate developer, a broker, a syndicator, over $800 million of real estate transactional experience. But really, at the end of the day, I'm a normal guy. I started out teaching high school and college band and became a self-made multimillionaire through real estate. And when the crash hit, that was really hard on me. And then, in this great opportunity of a down market, been able to rebuild my portfolio very quickly. I've never seen a better time to get started in real estate, or to, if you are already in real estate, to radically expand your holdings. This is a great time. Prices are low, interest rates are low. So beginning with the end in mind, what today is about, this isn't a sales pitch. We've got some fantastic faculty members that all offer very unique skills, but we're not here to sell you anything. This is not investment, legal, or tax advice. Each of our presenters may give an additional disclaimer on emphasizing that particular point, and this is not an investment offering. We don't have anything, there's no opportunity to invest in something today, even though we're talking a lot about investments. What this is, it's an educational service to our existing clients. So we lead through education, and we want to keep our clients well informed of the most current topics in our particular fields, because an educated client is a good client, someone who we can spend educating groups, and then when we interact with clients on a one-to-one basis, we can get a lot more accomplished. Also, this is I like to call it a job interview. We don't have anything for sale on the call today, but we do have stuff for sale. So if you do like any of the presenters today, you're going to get access to their contact information. I really like this faculty because these are my service providers. This is the team that I use to be a successful investor, and I can't give a stronger endorsement than to say this is the person that I entrust to be my advisor. So let's get started. Why? Real estate has huge tax advantages, and so in getting those tax advantages, we're really going to try to lump into 4 different categories today, and each of the presenters can take off on this idea if it's suitable. So we're looking at 4 ways to save, right? Tax rate reduction, so we're going to make our rate of taxes lower. Income reduction, so we're going to pay taxes on a lower amount, right? We want to make profits, but if we can convince the IRS that those profits are smaller than they actually are and do that in a legal way, then that's a prudent way to save taxes. We'll talk about tax deferral, meaning instead of paying the taxes today, we're going to pay the taxes in the future, and we're going to talk about legally how to avoid tax. Those are all good things. So on tax rate reduction, here's an example. Let's say you had $100,000 to invest, and you were going to get a 10% per year compounded rate of return. Over 30 years, your $100,000 can generate $775,000 of profit. That's a great profit. Real estate investors can make double-digit returns on a compounding basis. It's very possible in our field. And if you were to, say, pay 25% ordinary income tax along the way, then you're looking at $775,000 of profit. But if you were to lower your tax rate from, say, an ordinary income tax rate to a capital gains rate, that difference could be, $500,000 over a lifetime of investing. So that's powerful. If you're trying to maximize your profit, taxes are a big part of your tax strategy and your investing strategy. So reducing your taxable income is simple. Normally on the left-hand side of the screen, you take your gross income times your rate, and that's the tax owed. If you're working a job, that's very likely where you're at. If you're a real estate investor or a business owner, what's great is you can take your income less your deductions and less depreciation, and our faculty are going to go into this on a deeper level later, and then that's your tax owed. And the idea is that a real estate investor has opportunities to earn more and pay less in taxes. Tax deferral is a very important real estate strategy because it allows you to arbitrage. And the general concept of arbitrage is if you could, say, borrow money from the bank at 5%, that's a cost of borrowing, and you could invest at 10%, then you're making a spread, and that spread is called arbitrage. So you invest at 10, that's earnings, 5% cost, and the net is 5% yield. So if you're arbitraging the IRS's money, meaning you invest at 10% and you don't pay any taxes on that earning, on that profit right away, you can defer the obligation to pay that tax, then you're arbitraging the IRS's 0% interest rate, and that's a very powerful concept to take advantage. Our faculty are going to go through lots of different ways to create tax deferral. But let's say you're looking at on the left-hand side of the screen where you're making a profit and you're paying taxes along the way, and then on the right-hand side of the screen you're able to defer your tax until the very, very end. So you've got a gross profit of, say, $1.6 million, but you didn't pay taxes on that until the very end, and then you wind up paying at an ordinary income tax rate. Then you know the difference between the left and right columns is substantial because of that deferral mechanism. Tax avoidance. This is a really powerful way, and the Lermans are going to especially dig into how to legally avoid taxes, and they've got a great concept called swap till you drop. And the idea is you could more than double your investment earnings if you never pay taxes on your earnings, right? If you can make profits and never pay taxes on that profit, you're looking at doubling the amount that you earn, which could potentially cut your path to financial freedom in half. Right? We're all looking at real estate because it helps us compress time frames from where we are today into getting to financial independence or to a retirement earlier. And the way to compress time frames, a huge part of that is tax deferral, tax avoidance, and really looking forward to that. So what I do, I act as like a quarterback for your investing team. So I can help introduce you to different providers. Ultimately, on a business agenda, I'm a real estate developer. We build new houses in strong markets like Dallas, Texas, and we put them together in such a way that they become great investments for our clients. I am also a real estate syndicator. We buy commercial property that the goal is to cash flow and to force equity through commercial property. And I also provide coaching, one-on-one coaching to people that would like to be a developer or a syndicator or really get their investing to a higher level. I'm going to pass the presentation over to Amanda Hahn from Keystone CPA, and take it away, Amanda.
All right, thank you so much, David, for putting this together and for inviting all of us to be on the call today. We're really excited to be here, I'm really going to mainly talk about some year-end tax planning strategies because as we sit here today, oh my gosh, it's December 19th. I can't even believe that Christmas is coming so soon, and so it's important for us, around the holidays to still, keep taxes in our mind. I know that's a hard thing for a lot of people to do, but at the end of the day, when we talk about year-end strategies, we're talking about some maneuvers that we as taxpayers can consider doing in order to put ourselves in a position where we are either paying less taxes come April 15th or generating a bigger refund when April 15th comes. So let's go to the next slide. And I just want to real quick go over our current tax rates. So keep in mind these are what we consider the low income tax rates based on the changes that came out at the end of last year. Federal income taxes, 35%. State income taxes, of course, that's all over the place depending on where you live. But for me, as a lucky California resident, our highest tax is almost at 11% for income taxes. And then, of course, for all of us who either have a job or are working or have our own business. We also have payroll taxes and then capital gains. And Michelle, later on, are you going to be talking about estate taxes?
I am, estate tax and gift tax.
Okay, perfect, perfect. So if we can go over to the next slide. All right. And what I also wanted to do is I have my partner Matt with me here as well, who's who's going to be helping me with our part of the presentation. So what we wanted to talk about, in addition to all of those taxes that we just said in the previous slide, there's actually a brand new tax that's coming out that's called the Unearned Income Medicare Contributions Tax. Now, this is one where Matt and I, we do quite a bit of presentation on that not a lot of people know about. And so just to kind of give you a brief scenario, I mean, ultimately, what is the Unearned Income Medicare Contributions Tax?
Well, basically, it's like it says, it's a brand new tax on net investment income. So obviously the question always comes to mind is, well, what's net investment income, right?
Mm-hmm. And so I think what's important for all of us on this call, we're interested in investing in real estate or we are already real estate investors. The investment income that would apply to a lot of us, as you guys know, is going to be capital gains, for example. Anyone who does trustee investing or our lenders would be earning interest income. That's also considered net investment income. And also, I mean, I guess one of the most common ones that we see from an investor's perspective is rents. Right, so all of us who receive rents, that's considered net investment income. So again, in addition to all those taxes that we just talked about in the previous slide, now there's an additional 3.8% of taxes that's coming out starting in the beginning of 2013, and that's called the Unearned Income Medicare Contributions Tax. So there's not a lot of people talking about this, and I think Matt and I think one of the reasons is because of the name. The name itself is so misleading. You know, unearned income, Medicare contributions. Most people feel, even if they've heard of this, feel like that's something that doesn't apply to them. And so it's really important for all of us as real estate investors to understand that this essentially is a new tax on investment income. So whether we, invest in real estate, invest in the stock market, we have to plan for ways to minimize the taxes on our investment income. And I'll just briefly go over the next one, which is hospital insurance tax. Again, this is not a tax assessed on hospitals or insurance companies. This is actually a tax that's assessed on people like all of us here. Okay, it's essentially another brand new tax. This time it's on earned income, and it's 0.9%. And when we think about earned income, what are some things that come to mind?
Well, for obvious ones that come to mind, obviously, are W-2 income, or maybe you're a 1099 independent contractor working that way. Or maybe if you actually have a business that you're actually involved in, the pass-through income from the business may also fall into this category of quote-unquote earned income. Mm-hmm. So, the first tax here, the unearned income Medicare contributions tax, that's really is a lot.
Yeah, so you can see between this unearned income Medicare tax and the hospital insurance tax, they really, it actually encompasses everything. Because how do we generate money? Well, we're either investing for it, which potentially is going to be subject to this 3.8%, or we work for it through our business or our job, and that's potentially subject to this 0.9%. So, it's really important, as I was saying, I know it's so hard to think about taxes around the holidays, but it really now is the best time to start planning for ways to minimize our taxes. And that's why it's so important, and thank you so much, David, for bringing all of us here to really talk about some of the strategies we can use to protect ourselves going forward from all these crazy taxes that are coming out. And as I said earlier, this tax comes out January 2013. So it's still, I know it seems far away, but it'll be here before you know it. And what we want to do is have the strategies in place now, instead of waking up January 2013 to find out that a bigger portion of our income or our investments are going to be lost to these brand new taxes. So let's go to the next slide. We're going to talk about, we talked about the bad news of all these taxes. Let's talk about one strategy that we can all use to protect ourselves from both of these brand new taxes.
Yeah, this is one of our favorite ones, is looking at using your retirement accounts and redirecting money to your retirement accounts that otherwise might go to the IRS or to your state agency. And so what we're talking about here is just, this is one of the things we look at with our clients at year-end time is, hey, we're coming up with, you're going to owe $20,000 to the federal government. Why not make a contribution to your self-directed retirement account and bring that number down to the IRS? Because if you're going to spend money out, why not give it to yourself in your retirement account instead of the IRS?
Yes, and this is a great example. I mean, right now we're working so closely with Karen Hall from UDirect, which you're going to hear from later, just in making sure that we have the right types of retirement accounts set up. I'll give you an example. I was just working with a client earlier today, right before our webinar, and speaking with her about making a contribution to her solo 401k before the end of the year. And so for this particular client, what she's able to do is between the employee contributions and employer contribution, she's going to be able to stash away almost $40,000 this year into a retirement account. And again, it's, paying towards your own retirement rather than paying towards the IRS. For this particular person, she was in about a 40% bracket between federal and state combined. And so this saved her, off the top, about $16,500 in terms of tax dollars. And what's so great is that now this money is in her retirement account, and she can use that to invest in real estate, whether it's a specific property or in other people's deals. All of these she gets to invest, and in a tax deferred manner. So this is really, really huge. There are retirement accounts out there where you could open and fund next year and still get a deduction for this year. But there are other types of retirement accounts, and sometimes more powerful, where you have to actually get them set up and funded before the end of this year. And so I'm sure Karen's going to talk a little bit more about the details, but just make sure this is one of the items that you keep on your checklist in terms of what to do or what to speak to your tax advisor about before the end of the year.
And there's also for some of you, you may want to might make more sense to bypass any current year deductions and start looking at creating a bucket of tax-free money for life. So what are we talking about there? We're talking about using a Roth IRA or a Roth 401k. These are vehicles that are in place for you to build your wealth, and all the money that goes in is after-tax money, but it grows tax-free for the rest of your life. So obviously if you are in your 20s and your 30s, even in your 40s or 50s, it still may make sense for you to look at creating a bucket of Roth money, because just think about the compounded growth. It's all going to be tax-free for the next 30, 40, 50 years of your life. It's pretty powerful.
Yeah. Well, this is huge. Imagine having a rental property in your Roth IRA, right? That means you're generating tax-free rent for life, tax-free appreciation, and what if you could hold on to that property so you're living off of the rents that's coming out. If your retirement account can outlive you, imagine how great that would be to be passing off to your kids or your grandkids a rental property that's generating tax-free income throughout their lifetimes. This is huge, right? So let's go to the next slide. I guess we can talk just hours and hours and days about the benefits of retirement investing and self-directed. Let's go over the next topic, which is also important in terms of year-end strategy, which is income deferral. And this one is really important for any of you guys, whether you're an investor or a business owner. Look at opportunities to defer income that you're going to be receiving between now and the end of the year, okay? Because if you can defer the receipt of that income for even just a day, let's say you were going to be receiving $10,000 of 1099 income on December 31st, if you can delay receiving that just by 1 day into January 1st, 2012, that means you're delaying the associated taxes for a whole entire year. And that's really, really, powerful if you're someone who can control, whether you're invoicing or, just the way that you're collecting income.
Also, a perfect example of this, too, is for those of you who are real estate investors. We just talked to a client about this a couple weeks ago, actually. We were doing her year-end tax planning, and it came out in the conversation that she was going to close on the sale of one of her rental properties, and she was going to generate about a $75,000 profit on the sale. And it was going to close roughly, actually right around now, like mid-December. And so we talked to her about, is there a way that you can kind of defer the sale basically 2.5 more weeks until January 2nd? Obviously without killing the sale, without pissing off the buyer, any of that kind of stuff. But for her, she was going to pay probably roughly about $20,000 of taxes on that $75,000 profit. So just like Amanda said, next year her income and tax rates are going to be pretty similar. So it's not like she's going to be paying less taxes on it going forward, but it's the idea of deferring the taxes on it an entire year. So by her delaying the sale for 2 to 3 weeks, she can push back the taxes due on it for an entire 12 months. So it's pretty powerful.
Yeah, and this might be something that's really easy to do. Again, definitely another item on your checklist in terms of year-end planning. So let's go to the next one, which is the exact opposite of what we talked about, and this is accelerating expenses. Okay, and we don't mean go out and spend all the money that's in your bank account. Okay, please know that's not what we're talking about. Accelerating expenses, basically taking a look at what are the outstanding expenses that you think you will be incurring, whether between now and year end or maybe in early January. And think about whether it makes sense to prepay some of those expenses. Because if you're a cash basis payer, taxpayer, prepaying for those expenses, again, even by just 1 day, if you prepay that by December 31st, that means you get the tax deduction and the tax savings a whole year earlier than if you were to wait until January to make the payment.
Amanda, on that particular,
for cash basis.
On that point, for example, as a real estate developer, I've got, in a very specific point, I've got some houses that I've built, and I spent all the money to build those houses in 2011, and we're going to, instead of having a closing in the end of December, I can have a closing in the first week of January, and that's a situation where I can write, because I'm getting ordinary income developing this house dealer status, take all of the expenses in 2011 and then all of the income in 2012. Does that seem like a prudent strategy?
Oh my gosh, that is a great strategy, but I'm sorry to tell you, you can't do that.
That's what
and the reason, yes, and the reason is just to your specific situation is as a developer, what that means, as you know, a developer, dealer, you're treated as if you're holding inventory. And so what that means is that the expenses with respect to a specific property is deductible 100% in the year of the sale. So in your example, though, it still does make sense to look at the income deferral part. Like you were saying, if you're anticipating a $50,000, $60,000, $70,000 net profit on the sale of a property, it might make sense for you to, defer the closing by a few days until January of next year.
Yeah,
unfortunately, you can't accelerate the expenses specific to that property.
Yeah, I wanted to bring up that point because when you take a little bit of knowledge, like for everyone who's listening on this call today, you get really a good nugget and you say, well, that's a great idea. Let me go accelerate my expenses and defer my income. And then you hear that topic and you put it into practice like I just described, and it all comes down to your specific and individual situation. And so really when I started out this call saying that this is a job interview, the concepts that you're going to get on this call today are just enough information. Like you don't want to go remove your own appendix. You're just getting some ideas so that you could go to a professional advisor to take those ideas and put them into practice to your specific individual situation. And I was hoping that concept could illustrate that.
Well, thank you so much, David. And I just kind of want to go back to your point. So we talked about, some of the expenses that's specific to the development, you can't take a tax deduction, but, a lot of the other general and administrative fees still can. If you're paying for marketing expenses or you have professional fees, legal fees, all of those could still be accelerated into this year. And one of the big things in terms of, when we talk about accelerating expenses is that, even for amounts that are just charged on credit card by year end, generally still could be a tax deduction. So it doesn't necessarily require you to have cash out of pocket in terms of, expense acceleration. All right, so let's go to the next slide, and this is just a more in-depth discussion about accelerating expenses. In 2011, we're in a very special opportunity with respect to tax planning, and that is with the 100% bonus depreciation. And so what a lot of you might know, when we make big investments for our company, let's say we buy a car or we buy some machinery, a lot of times we take a tax deduction for that over multiple years, whether 5 years, 7 years, or 15 years or longer. Now, one of the opportunities with respect to 2011 is that for this year, for new asset purchases for our company, we get a 100% dollar-for-dollar tax deduction this year. Okay, the significance of this is accelerating your write-offs, right? Not having to wait the 5, 7, or 15 years and being able to push all of that into 2011. Two things to note on this. One, this has to be brand new items, meaning if you were to buy a car, it has to be a brand new car and not just new to you. Same thing with, computers or other types of equipment that you're using for your business or your investment. The second part of this, very important, this has an expiration date, which is December 31st, 2011. So again, look ahead into 2012 and think about whether or not I have any big purchases or asset purchases that I'm going to be needing for my business or for my real estate. We actually just had another conversation about last week with a client of ours regarding a new auto they were looking at.
We work with this client who has a very profitable, called hard money business.
Mm-hmm. Hard money lending. Hard
money lending business. And for him, he was looking at a substantial tax bill for 2011, so obviously we're looking for ways to reduce his taxes. And then the conversation came up as if he was considering looking at buying a new car just because they wanted it. Now, for him, obviously a great thing here is he's actually able to, he does a lot of traveling around the area and his marketplace to find investors, find deals, look at deals, all that kind of stuff to do his due diligence. So for him, he's able to justify that his vehicle is used a majority of the time for business, like 80, 90, even 100% of the time. So in talking with him, he came out that, well, he's actually wanted that one of those large, what is it, Lexus SUVs or something that are, I think they cost like 70, 80 grand or something. So we were talking, like, well, looking at it is if you actually buy this brand new vehicle this year, and again, for him, he's going to be able to justify 100% business use this year, he was going to be able to write off the entire purchase price of that vehicle, 80 grand, just in this year. Mm-hmm. So for him, he's at, I think he was at about a 40% combined federal and Cal rate. So that's going to save him a little more than probably $30,000 in taxes just in 2011. So if you think about it like this, vehicle costs 80, but it's going to reduce his taxes by 30, 32. So what's the net cost of that vehicle? Is really like 50, right? Mm-hmm. So for him, it was a huge opportunity, and that's the thing with this man was saying this does have an expiration. So if he was going to turn around and do that same strategy January 5th next year, he actually may only be able to write off like 50% of the cost of the vehicle, if that, depending on what Congress does and with all the tax law changes.
Yeah. So, I mean, that doesn't mean we should all go out and buy a brand new Lexus before the end of the year, but just to think about if that's something you're in the market for. Of course, another thing we were talking to a lot of people about is, we're doing a lot of holiday shopping. And so how do we make some of those deductible? Well, if you're a business owner or if you're a real estate investor, then a lot of these strategies can come into play in terms of helping you to minimize your taxes come April 15th. All right, so let's go to the next slide, and this is one of the last strategy we're talking about is for real estate investors. Now, you know, in the income deferral, the retirement planning, expense acceleration, we've really used a lot of examples that were specific to real estate investors already. This is just one main note that I want to talk about, which is not necessarily deadline sensitive, meaning it doesn't have to be done before year end, but we definitely recommend that you at least start the work if you haven't done so. And that is look at your opportunity to qualify as a real estate professional. Because, you know, earlier David was talking about, you know, you get to utilize, you know, all the tax write-offs and the depreciation to offset, you know, all of your income. Well, one of the greatest ways that you can benefit from your tax deductions is to qualify as a real estate professional. Just kind of high level, what this means is that you are able to utilize all of your real estate losses to offset your other sources of income, whether it's from your business or if it's from your the job that you have. And so it's really important. I mean, typically for our clients who are real estate investors and can qualify for the real estate professional, this can bring down their tax rates down to either, you know, the 15%, or a lot of clients pay no taxes because they're able to use their real estate expenses, depreciation, all the write-offs to offset all of their other sources of income. And so who's a real estate professional? How do you qualify? One of the most common myths that I hear all the time is that, you know, you have to be a licensed realtor or broker. And I just want to make it clear that that is not one of the distinctions. Okay, when it comes to the IRS, there's really only two rules that you need to meet in order to qualify for the real estate professional status and to take the, you know, unlimited write-offs against your other income. And those two criteria are, one, you have to spend at least 750 hours in qualified real estate activities, and two, that you spend more time in real estate than you do in all of your other jobs or other, you know, for-profit activities combined. And so one thing to think about before the end of the year is to go through your calendars, go through you know, your mileage log, and try to document the number of hours that you've spent this year with respect to your real estate activities, so that, you know, by the time April comes, you can, you know, find out for sure whether or not you qualify for the real estate professional status to get all the tax deductions. Again, you don't have to do this before December 31st, but it's something good to start doing now so that you're ready by the time tax season comes. All right, so that's it for our portion of the presentation. Our contact information is you can see that on your screen, and if any of you guys have any additional questions on any of the strategies we talked about, or questions that you have on what you should do before year end, definitely feel free to give us a call, and we'll be on the line till the end. I guess if we have Q&A as well, right, David?
Yeah, absolutely. We'll have some Q&A at the end. So thank you, Matt and Amanda, very much. They have written a great downloaded ebook that we'll make available to the listeners of this conversation. So look in your email box, and we'll get you that that information. So when as a real estate investor, when I'm looking at my resources that I have available to me to invest, cash is definitely important. Cash flow is important. Your credit and your equity are all important. And I call those the above-the-line resources. Those are the things that you can traditionally tap into when you're looking at how do you invest into you know, stocks or bonds or mutual funds or real estate or any other type of investment that you're looking at investing in. And then what I call them below-the-line resources, which is your time, your talent, your strategic relationships, and your control of an opportunity. And those are important because when you're looking at the difference between above-the-line and below-the-line resources, in a traditional IRA, you can only stick your cash in. That's the only thing that the traditional IRA can benefit from. But when you're looking at how do I self-direct my IRA into real estate, you can absolutely your talent at picking deals and your strategic relationships with people that have good opportunities, and not necessarily your time doing the management of the property, but your time evaluating particular investment opportunities. All of those are great assets that are intangible, and you can contribute towards your financial independence and using a self-directed IRA for that tax deferral method. And I'm really, it's my pleasure to introduce our next speaker, who is Karen Hall, who is the CEO of UDirect IRA Services. And Karen, why don't you take it away and give us some great ideas on how we can create tax deferral through the use of a self-directed IRA.
Thank you, David. I just love to, and I really like your slide showing the difference between a typical IRA and a self-directed IRA. As David said, my name is Karen Hall. I'm president of UDirect IRA Services, and what we do is we provide the self-directed account that lets you take charge of your retirement. What we don't do is we don't offer tax advice. That's why we refer so many of our clients to Matt and Amanda at Keystone CPA, because you really do need a good tax advisor so you've got a strategy. When you've got that strategy, we help you implement it with a self-directed IRA. We don't give legal advice either, which is so wonderful to have attorneys on this call, because you really do need some good legal advice when you're making these investments. And then to have David, a financial advisor, what a great team. David, I'm very excited you put this team together, because these are the kinds of professionals. You need one of each, on your staff, on your own personal team. So to get to the point here, the difference between a self-directed IRA and a typical IRA, what is it? The only difference is the asset that the plan can buy. With a typical IRA, it's stocks, bonds, and mutual funds, you're done. Maybe throw in a CD, for flavor. But with a self-directed IRA, it is literally anything except life insurance contracts and collectibles. So you can invest in real estate, in notes, in private stock, in gold bullion. You can invest in tax liens and just so many things, mango trees in the Philippines. As long as it's for investment purposes, you can invest in it. So going on to the next slide, we'll talk more about, self-directed investing and really the limits. So like I mentioned, the only things you can't invest a self-directed IRA in are life insurance contracts and collectibles. So your fine wine collection won't go in your IRA. Your art collection doesn't go in your self-directed IRA. But really, anything else, if it's for investment purposes, it can. So on the next slide, as we move forward, and we're going to talk about what are you going to do if your retirement funds are with your current employer. Say your retirement money is with your current employer in a 401k. Well, first off, congratulations to you that you took the time to invest and save, and hopefully take some employee deferral. If they're contributing 3%, it's free money, So that's such a great idea. But if your money is there in that 401k, chances are you can't use it. You'll have to really request an in-service transfer from your current plan administrator in order to be able to utilize those funds. But typically your plan administrator won't allow it. It's usually only the case of if you're 59 and a half already, or if you have a financial hardship. So again, if your funds are with your current employer, you're probably not going to be able to self-direct those particular funds. All right, moving on. We're going to talk about some of the rules of self-directed IRA investing. This is really important to have a positive experience with the self-directed IRA, because if you understand the rules going in, you'll say, okay, well, I knew that, because these rules aren't really very intuitive. The rules are really written in the Internal Revenue Code, the IRC, but the Internal Revenue Code is distilled into some publications, and one of them is Pub 590. You can go to irs.gov and look up Publication 590, and it's going to tell you about IRAs. What it's going to tell you isn't what you can invest in, just what you can't, but it's also going to, here it outlines some of the rules, and we'll discuss these in greater detail. But number one, you're not going to borrow money from your own IRA. You're not going to sell property to it that you personally own. So if you own, let's say, a rental property today and you want to sell it to your IRA, no, that would be a prohibited transaction. You don't use your IRA as security for a loan, and you're not going to use your IRA to buy property for personal use, whether present or future, if it's an IRA. All right, next slide. We're going to talk more here about the rules. Certain people are qualified and okay, and certain people are disqualified. So this is very important to understand. This is really one of the really big takeaways of what I'm going to talk about today. Disqualified people are your lineal ascendants and descendants, plus any fiduciary to your IRA. For example, like a realtor or your attorney or your CPA. Your IRA isn't going to buy a condo that your CPA owns, for example. So, but these lineal ascendants and descendants usually are the ones that get in the way. And this is what I mean by ascendant and descendant. It's your parents and grandparents and their spouses, you and your spouse, then your children and even your grandchildren and their spouses. Lineal ascendants and descendants are disallowed. Now in the next slide, we're going to talk about who is allowed. So where the people that go up and down your family tree are disallowed, the people out to the sides are just fine, like your aunts and uncles, your cousins, your brothers and sisters, your nieces and nephews, they're fine. So say, for example, your IRA, your self-directed IRA, purchased a rental property, and say it was right next to a university. And so you thought, well, this is wonderful because my son and my nephew are going to this university. They can just rent it. Well, the truth of it is, your nephew could rent that condo from your self-directed IRA all day long, but your son could not. Your son is disqualified and cannot have any use of that asset that your IRA owns. Okay, next slide. When it comes to prohibited transactions, they pretty much fall into these three buckets. And this really is, again, the takeaway from today is like, how do I use a self-directed IRA? This is what's really important to know. And number one is that neither you nor any disqualified person can have benefit from the IRA. That's present benefit, that's implied benefit, it's future benefit. And well, the only benefit is retirement benefit, okay? So it's indirect benefit is another thing you want to avoid. So here's an example. I had a client come in to me. He's an appraiser, and he wanted to have his brand new self-directed IRA lend money to his sister-in-law. Well, his sister-in-law is one of the people out to the side, right? She's allowed. But the people, so I said that that's fine. The sister-in-law is absolutely fine. But then I said, well, when your sister-in-law gets that money, what is she going to do with it? And he said, oh, well, she's going to lend the money to my business. Big problem. The money starts in this man's IRA. It can't end up in his business. That's present benefit from his IRA money. So he still went ahead and lent the money to his sister-in-law who invested in something else. But the IRS has something called the indirect rule. If you can't do it directly, it doesn't mean you can go through this person and that entity and that other person and have it come back to benefit you. You have to make sure that there is no benefit at all, because they're going to look at where does the money start, where does the money end. Okay, number two here on our sheet is that you're not going to buy, sell, or exchange property between the plan and someone who's disqualified. So what that means is that your IRA isn't going to, for example, buy property that your father owns because he's disallowed. Your IRA isn't going to sell property to your son. These people are disqualified. So that's pretty easy to understand. You're not going to buy, sell, or exchange property between the plan and any of these disqualified people. But number three is a little harder to get your brain around. In fact, I just was on a phone call about this. A disqualified person can't provide goods, services, or facilities to the plan. Today I had someone call me. She's a realtor, and she wants to have her IRA buy some real estate to fix and flip. She says, well, can I be the listing agent on this? Can I take a commission? No, you can't. That would be a prohibited transaction. You can't provide goods, services, or facilities, and you certainly can't have any present benefit. So in that case, if you're a realtor and you want your IRA to be buying rental property, let another realtor handle it. Typically, realtors have reciprocal relationships with other realtors. This is one to give to your buddy and let them deal with it, so it's not a prohibited transaction. The best rule of thumb is to keep it arm's length. Now, if your IRA owns a house, say, and whether you're a realtor or not, one thing you're not going to be doing is going out there and swinging the hammer or painting the walls, because you're not allowed to provide services to the IRA asset. So you're not going to do what's called an over-contribution of sweat equity. You're not going to get in there and do all the work. So these are the prohibited transactions. If you have a deal and you want to discuss it, give me a call and I'll go through it with you. All right, let's move on to the next slide. The structure. I think this is very important because a lot of people misunderstand the difference between themselves buying a piece of property. Again, we're going to use this example of real estate. When you go out and buy a house, that's one thing. You're the buyer. But when your IRA buys real estate, your IRA is the buyer, and guess what? You don't sign the offer to purchase. We sign it. The custodian for your IRA signs the offer to purchase. The name of the buyer isn't your name. It's the custodian for the benefit of your IRA. And that's extremely important to understand, that when your IRA is purchasing property, you're not making the offer in your own name, and you're certainly not giving an earnest money deposit, because that would mean that you had an interest in the property and it could create a prohibited transaction. So really important to understand that you and your IRA are separate entities in this process. Then there's UDirect IRA Services. We're your go-to. We're your point of contact for your self-directed IRA. And we utilize the services of a custodian that holds the money, a trust company called American Estate and Trust. So this right here is the structure for your self-directed IRA. Okay, next slide. The pros and cons of buying real estate with an IRA. The pros are definitely, number one, is that this is where the money is. It's so difficult these days to get a loan on rental property. And even if you wanted to do it, if you own, say, more than 4 or so properties, well, then you can't get a loan because, you know, you're maxed out. So this is where the money is. There's something like $15.7 trillion in retirement money. Only 4% is tapped as self-directed. So this is something that you can really tap into for your deal. Maybe partner with someone else's IRA for their deal. All capital gains and tax flow, tax-free or tax-deferred. No time limit for holding the property. You could buy it today, sell it tomorrow without any particular tax ramification. Your IRA can buy a property and sell it in 12 years, and that's fine too. An IRA can actually borrow money, which we'll talk about, and there's a potential to earn a larger rate of return because, say, for example, you buy a house for $100,000, you sell it for $200,000. That $200,000 comes back into your self-directed IRA, and it's not diminished by taxes. The entire $200,000 can go back into your next deal, so it helps you compound your earnings faster for that reason. Okay, next slide. Now we're going to talk about the cons of buying real estate with your IRA. I think that sometimes when people buy real estate with their IRA, they think that they're going to get the same tax advantages that they get buying real estate outside their IRA. They don't. You're not going to take any write-offs or anything. With self-directed IRAs, you get the benefit when you retire. So the benefit is that you get this tax-free, tax-deferred growth. Now, of course, you are solely responsible for any gains or losses in your IRA because you're the advisor. You're the one who is advising yourself, really. And you're not going to be able to replace losses easily, so you want to make sure that you do your due diligence beforehand, before you invest. Okay, next slide. Now, how do you get real estate into a self-directed IRA? This is the process. And be sure and do it in this order because you're going to do yourself a big favor. Again, at least once a week I get the phone call where someone says, I found a house, I'm so excited, I'm in escrow, I want to open a self-directed IRA right now. That's a mistake because it takes a while to get the self-directed IRA open, funded, so that you can invest. When you give us the paperwork, we open your self-directed IRA right away, but you have to get money into it. And to do that, typically you're going to transfer or roll money over into it, and that can take 2 weeks. So if you find the property today and you open the IRA today, you're not going to have any money to go into your deal until your current custodian transfers the money over. So do yourself a favor, open and fund a self-directed IRA, then go shopping for the property, then find the deal that you can't live without. And remember, it's the IRA that's the buyer. So the name of the buyer is custodian for the benefit of the IRA. The custodian signs the offer to purchase and all the docs because the IRA is the buyer. So what you do is you give us a direction letter. That's our form. It's a very simple one-page document, just your name and how much and in check or wire, that sort of thing. So you give us a direction letter and the supporting documentation, which would be the purchase contract. And then when it's time, we will fund that deal. Funds are wired. You fund, you record, you get your keys, your tenants move in, and the tenants can make their rent checks payable to your IRA. Okay? Now I think when we talk about this, it's important to understand that when you're talking about real estate, there are certain things that you can do before it's considered an over-contribution of sweat equity. So what you can do is you can screen tenants, you can physically pick up and collect the rent checks, and you can hire third-party vendors. Now, over and above that, you're not allowed to do the property management, like you're not going to do any repairs or anything like that yourself. You're going to keep it arm's length. All right, let's go to the next slide then. there is something called a Checkbook IRA, and you may have heard of this. Now, the Checkbook IRA is really a nickname. It's sort of a misnomer because it can be misleading. What it really is an IRA-owned LLC. All right, it's a special purpose LLC that's drawn up by an attorney. Your self-directed IRA is open and has money in it, and then it buys the initial units of the special purpose LLC. So now your IRA owns an LLC, and then the money is transferred from your IRA into the checking account of the LLC, and you are the managing member. So as the managing member, you have checkbook control. But what's important about this is that that checkbook, bless you, those funds are IRA funds, and you must follow all the same rules for investing that money as you would as if you were going directly through us. So that you completely understand this, I have recorded with an attorney a 1-hour presentation that you really should listen to before you do this. So you can email me at khall@udirectira.com, and I'll send you the link so you can hear about this and really learn, because with great freedom comes great responsibility, and this is a very good example of that. We really want to make sure you're educated going in.
On that point, Karin, because I put this artificial constraint on Karin's presentation today from the sake of time. You know, we've got so many great presenters to get their content out. There's no way for you as a listener to get all of the rules and nuggets around self-directed IRA. So definitely take Karin up on her offer of getting a more comprehensive webinar or recording on the subject.
Well, and you know, there's just so much to know, and that's what I'm here to do, is to teach. Why don't we go even further on to the next slide? Because what this is going to talk about right now is the types of self-directed plans that are available. So you've heard the self-directed IRA, but even that is a misnomer because it's limited. So a self-directed IRA can be a self-directed traditional IRA, a Roth, a SEP, a simple, even a self-directed inherited IRA that you inherit from someone who passes away. You can self-direct employer plans, although UDirect doesn't offer them. The four plans, the defined benefit, and the profit sharing, we don't offer those, but we do offer the individual K, which really has a lot of bang for the buck. And you can also self-direct a Coverdell. That's also called an ESA, or Education Savings Account. And there's an HSA, a Health Savings Account. So these are all self-directable. So just keep in mind, it's not just the self-directed IRA. All of these accounts can be self-directed. Okay, next slide. So how do you do it? How do you self-direct? It's a 3-step process. You can open, you can fund, and you can invest. So you open an account by filling out an application online at udirectira.com. We have applications. The first page is called an intake form. You type on it, and it fills out the entire rest of the document. Then we need about 6 pages back. We open your account. Then you want to put money in, and there's 3 ways to put money in an IRA. You can write a check and make an annual contribution. I think Matt and Amanda were talking about that, how instead of paying taxes, some of their clients made a contribution to their IRA, and it reduced their overall tax situation. So you can write that check and make an annual contribution. You can transfer an IRA to IRA transfer. To do that, you fill out our transfer form and you sign it. You give it to us and we sign it, and we send it to your current custodian. That's how you transfer. Now the third way is a rollover. If you have a previous employer plan like a 401k, a 403b, 457, and you're no longer working there, you contact your employer, previous employer, fill out their paperwork, and they will begin the rollover process. So once the account is open and the money's there, then you direct, right? You tell us what you want to invest in, and that's how it goes. All right, so next slide. Here it is for more information. If you'd like me to send you more information about IRAs borrowing money, more information about the Checkbook IRA, or more information about anything that I've discussed today, please do send me an email. It's khall@udirectira.com, and our toll-free number is 866-538-3539. And David, I just want to thank you, as Matt and Amanda did, for putting together this wonderful webinar. I really appreciate being able to be a guest, so thanks again.
No, it's great to have you as always, and Karin and I did a great webinar a few weeks ago where we had a lot more time to really dig in specifically on how to use a self-directed IRA to create hassle-free cash flow investing. And you can watch a recording of that that webinar that we did. It's on my website on the blog section. Just go to hasslefreecashflowinvesting.com and you can watch that video. So thanks for getting all of your important thoughts condensed and quickly as you could. We talked about tax deferral. We talked about lowering your tax rate. We talked about lowering the amount of income that your tax is paid on. But the thing that excites me most is, how do I legally avoid paying taxes at all? How about I pay zero? That's my favorite number, is zero in taxes. And to talk a lot about that is one of my favorite people, and that's rare to say that an attorney, let alone your attorney, is one of your favorite people, but I love spending time with Michelle, and we're really gifted and lucky to have her on the call today to share with us really how to use a proper estate planning to create to create a tax advantage situation or to avoid paying taxes ever. Michelle is really one of the most qualified attorneys. Not only is she really friendly and nice, and that's important when you're working with the subject of estate planning, is to have a very high level of comfort. We've worked with Lerman Law Partners for a number of years, and Michelle is my personal estate planning attorney. And again, that's the highest endorsement I can ever give, is to say, who do I trust with for my advice, and who do I send money to get that advice? And Michelle is the one. Certified specialist in estate planning. She's recognized as a super lawyer for Northern California for 2009 to 2010. She is part of the Marin Estate Planning Council, co-founder, head mentor group in the Marin County Bar Association, frequent lecturer. I have the opportunity to hear her on radio frequently. I'm sure that Michelle can put you in touch with many of her radio interviews. And she has my vote, along with the vote of a lot of other people, to become the #1 favorite lawyer based on Reader's Poll. And you spend any amount of time with her, you'll know she's a super, super smart lady, graduated magna cum laude. And let's welcome to our call today the wonderfully smart and gifted Michelle Lerman.
David, thank you so much. I really, really am honored by that introduction. Thank you. And I always start, I'm a lawyer, so I always have to start by just telling you that we don't have an attorney-client relationship in this webinar. As David mentioned at the beginning, we're not selling you anything, we're not representing you, we're not giving you any legal advice, any tax advice yet. We'd be happy to do so. I always ask people when they come to my live seminars, what's the first thing you do when you hire a lawyer? And a very, very nice gentleman in the front row said, you pay them money. That wasn't really the answer I was looking for. What I was trying to get across is that you sign an engagement agreement. So with the next slide, also I'm not giving you any information about how to avoid penalties that may be imposed by the Internal Revenue Code. But let me tell you what we are going to talk about. So far, David, with this panel that you've put together, we've really been focusing so far on income tax including capital gains tax, how to defer that and have compounded growth through investing through retirement accounts. And now we're really switching gears, and we're going to talk about estate tax and gift tax. So we'll go to the next slide to get started. And we're going to focus on critical planning that you can do for this year. Why this year? Well, the first thing I want to tell you is that, as you probably know, in late December of 2010, so a year ago, there was a tax act that passed that completely changed the landscape of estate taxes and gift taxes. First of all, for the first time ever, we have a $5 million basic exclusion. And I like to keep things simple, so if at any time you're not understanding anything that I'm saying, feel free to just send me an email, or you can also respond and just I can see your questions as I speak. But what do I mean by that? I mean that you can give away $5 million. That's what I mean. You can give it away during your lifetime, or you can give it away at your demise free of transfer tax. In other words, you can give away $5 million free of gift tax if you give it during your lifetime or upon your demise without paying any estate tax. If you are going to make a gift and there is going to be a gift tax, or if upon your demise your estate exceeds the amount that can pass estate tax-free, then we have a flat 35% rate. That is huge news. That is revolutionary. I mean, it used to be that you could pay up to 55% in transfer taxes upon your demise. But here's the trick, and why I'm so happy to be talking about this now, is that the law does sunset, and it's supposed to sunset at the end of next year if nothing else happens, but we really don't know. We really don't know what could happen, and it might even the law might even be changed sooner. So next slide, we're going to talk about this $5 million exclusion. The New York Times actually referred to it as a gift tax bonanza, that you can actually leave an extra $8 million. Some of you, the listeners, are probably thinking, I wish I had $8 million to give away, but it doesn't necessarily have to be $8 million. You could leave $500,000, you could leave $1 million. The point is that you can leave a higher amount than ever before, and you can leave it during your lifetime. Next slide. So you could give me a certain amount of cash. You could give it to anyone you want and pass that free of gift tax and free of estate tax, but you could also leverage the gift. In other words, really you could gift even more than the exclusion amount, or what might be perceived as more, by using an advanced technique like an installment sale or a QPERT or a life insurance trust. And we'll go to the next slide because today's talk is really about giving you an overview, and I just want to hit on some key points. But if there's anything that I'm talking about that if you do have an estate that you think you're going to be subject to estate tax upon your demise because it's over, say, $3 million, I do want you to send me an email, and I'm happy to sit down with you and we can talk further about which of these techniques are right for you. Here's an easy one to do. You can pay, in addition to any other gifting that you can do, you can pay for tuition and medical expenses directly to the provider. It's an unlimited amount. You need to do it, though, direct. You can't say if you want to pay for college tuition for a grandchild, for example. You can't reimburse your children for the tuition expense. You have to actually pay the tuition directly to the institution. Next slide. The other thing that I want to mention, I think that the slides actually skipped, David. I think that there were, yeah, I think go back. Yeah, annual exclusion gifts. We're a little bit out of order, but that's okay. So here's something that I want you to consider before December 31st, and that's called an annual exclusion gift. So in addition to the money that you can leave free of estate tax when you die, or you can leave it during your lifetime, every person can leave $13,000 to anyone that you want. What are we talking about? Let me just back up. We're talking about ways to reduce your assets so that upon your demise, you've reduced your estate tax because you've reduced your estate. So the first thing I talked about is giving away up to $5 million. The second thing I talked about is paying tuition and medical expenses. And the third thing that I'm talking about are annual exclusion gifts, that $13,000 that you can give away. You can give it to children, to their spouses, to the grandchildren, to friends, to really anyone that you want. people often think about the end of the year. You might have parents who have a large estate and they often give gifting at the end of the year. Here's another thought for you. Don't wait till the end of the year. Go ahead and give this year's gift by December 31st, but next year's gift, give it in January. Let it be invested for grandchildren or invested some way that grows throughout the year. Why wait another 12 months? You can give the annual exclusion gift once a year. Why wait till the end of the year? But if you haven't done it, think about it. It's a way of tax-free just getting rid of a lot of assets if you don't need them and if it's going to be subject to estate tax upon your demise. And again, it increases the amount that you can then leave outside of your estate. Next slide. And we did that one. So, next slide.
And I'll just come out here. We'll see which slide we're missing.
Yeah. So so let's go down to the end, and then I'll just about be ready to turn it over to Jeff. So I think that if you look at the couple in this slide and they're smiling and they're happy, I think from my experience, what I know is that sooner or later an attorney is going to be handling most people's estate. And what I find when people leave my office and they give me a hug and they say that their planning is done, it just brings such peace of mind. And so I always remind people that as you're going into the new year and you're thinking about what your New Year's resolutions are, to think about getting your planning done, because it's never too soon to plan, but sometimes it's too late. And the sooner you do it, generally the less expensive it's going to be and much more efficient. It's just a much more efficient way to pass on your estate once it's been planned. So next slide, I'm going to offer you a free special report. What you don't know can hurt your family. 5 easy ways to make sure your children, wishes, and assets stay protected should something happen to you. It's just 5 simple but critical facts that you really have to know in order to make sure that your family's protected. So feel free to email me, Michelle at Lerman Law, or feel free to call us 1-800-5-LERMAN, L-E-R-M-A-N, and you'll see our phone number on the slide, and I'll turn it over to Jeff. Thank you so much.
It's my pleasure to introduce a good friend of mine, and again, my go-to source for legal information when I need support as an attorney. Jeff and his team has represented me in both litigation, unfortunately. They did a great job, just unfortunate whenever you have to litigate, and they represented me in transactional work, both in securities as well as just transactional real estate. Jeff's a very experienced real estate investor himself. I think that's one thing that really separates him, is his ability not only to think like an attorney, but to think like an investor. Huge number of very highly credible guy. Jeff's got a high presence in the media. You can hear him on the news in the San Francisco Chronicle quite frequently. And without further ado, let's turn this over to Jeff Lerman.
Thank you very much, David. I appreciate it. Yes, go to the first slide. Thank you. As most real estate investors probably know, when they sell their investment, they can potentially defer their taxes on any gain by doing a 1031 exchange. Depending on the size of that investment, those savings could be in the millions of dollars. And if they use the strategy correctly, they could keep deferring those taxes until they pass, or as we say, swap till you drop. But here's what most investors don't realize. If you currently hold your investment in an LLC with one or more co-members or partners, you are essentially joined at the hip when you sell. What do I mean by that? I mean that if you want to do a 1031, but your partner doesn't, let's say your partner wants or needs to cash out instead of exchanging into another investment, then unless you can get your partner to agree to do a 1031, you can't. You and your LLC co-member have to do the same thing. So if you want the flexibility when you sell the property to be able to go your separate ways, then you can do that if you convert your LLC into a tenancy in common. But you generally have to complete that conversion in a prior tax year. That means if you think there's any possibility you're going to sell one of your LLC-owned real estate investments next year in 2012, then you must take care of this conversion before December 31 of this year. And here's another big point. If you do that conversion and you still want the asset protection benefits of an LLC, you need to form a new LLC to hold your TIC interest. So David, for example, if you and I own a deal in, let's say, DJ Investments LLC, we enjoy certain asset protection benefits from that LLC. If we convert to a TIC, to a TIC vesting of ownership, where each of us owns our own TIC interest in our individual capacity, then we've now exposed our personal assets to creditors. What we need to do is vest our respective TIC interests in our own separate LLCs in order to continue those essential asset protection benefits. Next slide, please. Section 195 of the Internal Revenue Code gives you a tax deduction of up to $5,000 of your startup expenses that you spend before December 31, 2011. So if you're thinking about forming a new entity to own your real estate, you could save money if you form it this year. Next slide. Many investors have fewer of their investments today than they did at the beginning of 2011. This obviously has been a very, very difficult year. So either because you sold your investment or you lost it to foreclosure. Do you own any LLCs or corporations that you no longer use? If you don't dissolve those unused entities, they will cost you $800 per year in the annual minimum franchise tax. And I don't know, David, if we just have California residents listening in, so that this is a matter of state law. I'm talking about the California Franchise Tax Board annual minimum franchise tax. If you're calling in and you're from another state, then check your local state tax board.
Jeff, I've got a question on this particular point, because we do have people from all over the country and potentially all over the globe on our call today. Let's say an entity is not doing business actively, but there's still some potential liens or unknown opportunity for judgment. Let's say your entity didn't pay all of its bills. How do you dissolve the entity, if you think there's some unpaid bills out there?
So, great question. Again, this is the answer is going to vary depending on state law. So I'll answer it for California. I would imagine California's law is probably fairly typical, but do check with your local counsel. In California, if you're going to dissolve and wind up an entity, one of the things that is required is for you to identify all of your creditors and notify them that you are planning to wind up and dissolve, and make sure that you have adequate capital to take care of those creditors. That's part of the whole procedure. So if you find yourself in that position, then you're going to have to deal with it. You can't. The idea here is you can't. The legislature does not want you to be able to manipulate your wind-up and dissolution of your entity to the disadvantage of your creditors. That's not the purpose of your entity. So these next few weeks do present a final opportunity to dissolve any unnecessary or unused entities this calendar year. If you delay the dissolution by even a week, it'll probably be too late to take care of it this year, meaning the Franchise Tax Board will assess another $800 MFT, minimum franchise tax, against your entity. So, a lot of us we forget what entities that we have, or we procrastinate. This is something you don't want to procrastinate on, because when you get that $800 bill next year, you're going to be kicking yourself. Next slide. The final point is, if you have any intention to form a new entity in the near future, keep in mind that the Secretary of State offices generally get very busy with new filings at the beginning of January. Everybody comes back from vacation. Time frames could be longer, and that means your deal may get delayed. One of the other speakers, I think it was Karin, was talking about this notion of adequate planning to make sure you are getting your ducks in a row and organized before you go out there and invest in your IRA. Same thing applies to an LLC. Depending on what state you're forming in, it could take weeks, sometimes even months if, for example, you're forming in Arizona, and you need to, so if asset protection is important to you, and it should be important to every single one of you on this call, then you should pay attention to this and make sure that you are laying the proper groundwork to invest the right way. The best way to avoid that delay and the hundreds of dollars of additional cost involved in having to pay for an expedited filing is to form your entity now. Here in California, I believe it's currently taking at least 6 weeks to get through on a standard LLC filing. If you find yourself in a position where you need expedited treatment on that, it's going to cost you, I think, about $500 extra for the attorney service, not us. This is just for the attorney service to do it over the counter, walk it through. So your state may vary, but that's it's just something that you want to make sure you take take care of before it gets too late.
I think the real solution, Jeff, is you just avoid doing business in the state of California and do business in the great state of Texas. You can get it done in 24 hours. They've got that's their turnaround time.
Well, don't get us started on all the reasons why California may not be the best place to be doing your business. The problem is that many of us do live here, and the state extracts a certain fee for the privilege of doing business here in California. So as David mentioned, all of us are doing some special reports. The one that I'm offering, although we have several I'll tell you about, but the one that I think might be of most interest to the people on the call today is called When Your Property is Under the Magnifying Glass, What Every Investor Must Know to Get the Maximum Purchase Loan, Refi, or Sale Price for Your Property. However, if you go to our website, and David, on our last slide, you have my email address, but you also have our website URL on an earlier slide, which is lermanlaw.com. And if you go to our homepage, you will see that we also, if you scroll down to the bottom, we have several free special reports that you can take advantage of. And if you go visit the articles page, you'll see a lot of free information, free resources. And we also have a lot of other educational home study courses for investors that you can take advantage of if you go to my education company website, which is www.IEIS, as in Sam, IEISonline.com, which stands for Investor Education Institute Series. And it's some of the, I think, the most unique real estate investor targeted education courses that I've seen out there. So with that, I'll turn it back over to you, Mr. Campbell.
Terrific. If you missed that web address, I just posted it in the chat section so you can all see that. Really, this has been a great panel and very high-level information. I think if I were on the other end of this call today, I think I would be scratching my head saying I feel more lost than I did 90 minutes ago. And the idea, in a sense, is that is really just a teaser. And anything that's an introductory concept, I mean, we gave you a lot of content, and the idea was to help you create your list of questions. And if you have a lot of questions, then we did a good job because we got you to think about your particular situation and what your needs might be, and we've assembled a great team of people that can help you find the answers to your questions that you're looking for. We have just a few minutes left at the end of this call that we've allocated towards question and answer, and if you do have a question, you can send it to me in the chat section, or if you want to actually ask it live, you can just raise your hand and I can unmute you, and if you want to ask your question live. So I'm going to if you've got your hand raised now, I'm going to make your hand go down, and if you want to ask a question, you just raise your hand. And okay, we're going to go to Burj. I'm going to unmute you, and Burj, go ahead and ask your question. Burj, can you hear us?
Yes.
Great. What's your question for our faculty today?
What's the best way to buy a property under? Is it better to buy with your trust
Well, I'll take point on that question, and then the faculty can follow up. And the ultimate question is, it all depends. And so one of the things that my company does is in a one-on-one strategy consultation, we understand where you're trying to achieve, what resources that you're working with, and then help fill in the gaps between the two. Because I like to say there is no such thing as a good property or a bad property or a good investment or a bad investment. There's really what is a property that's suitable to its existing owner and the timing of that investment in your particular ownership objectives. And so really, in order to answer that question, we have to figure out what's suitable to you. Any of the other faculty want to jump in on that question?
This is Jeff. I'll take one. So I think that the question actually reflects a common misunderstanding that that investors have, which is that a lot of times that question, the unspoken question is, what's the best way to take title to protect my assets? Because that's, again, paramount in most investors' minds, or at least it should be. And there's a common misconception that trusts provide asset protection, and they don't. And Michelle can corroborate or speak to another dimension of that in a minute. So if you do what Michelle and I do, since our practices together, she's estate planning, I'm transactional litigation, is we look to integrate your estate planning with your asset protection. And so if you're going to have a trust, then what we will do is, if it's appropriate for you, form an LLC where the membership interest in the LLC, which is the evidence of your ownership in the LLC as opposed to in a corporation, the evidence of ownership is stock, your membership interest will be owned or vested in the name of the trustee of the trust, and that's how we integrate that. And of course, if there is an IRA involved, then that's going to be another layer of complexity that we would need to take into consideration, and that it's probably too complicated for us to go into in this call.
Well, I would add to that when it comes to asset protection in an IRA, that's where the Checkbook IRA or the IRA-owned LLC comes into play, because the assets become, the money that you transfer into the LLC is, of course, owned by an LLC and has that kind of protection. But, of course, you're the attorney that can address the legal benefit of that, but that's the technical way that it works.
Great. If you've got another question, feel free to raise your hand. Otherwise, I'm going to go to the questions that were texted in. Renee Lewis asks, what about income limitations on real estate professional status? And I think, Amanda, do you understand the question, or do you want me to explain a little bit more?
Do you have more information from the text?
No, I don't. I'm thinking what they're asking about, and I'm going to guess. And Renee, if we're missing your question, feel free to add, is there a maximum amount of income that you have to have, or a minimum amount of income? Maybe talk about the $100,000 to $150,000. Once you get to $150,000, your limitation on passive loss versus active loss.
Okay, so there's a couple different rules in terms of how you benefit from your real estate deductions. And when we say real estate deductions, we're talking about, all the regular expenses like mortgage interest, property taxes, as well as depreciation. So they're all considered part of the same. So generally speaking, if your income is below $100,000 and you're not a real estate professional, then you could take up to $25,000 of excess losses from your real estate to offset other sources of income. So to take a step back from that, what that means is, whenever you have rental income, you could always use rental expenses to offset that rental income. Okay, there's no limit to that. But what typically happens with real estate is, even though you're cash flowing positive, you would a lot of times have more tax losses because we can write off the purchase price via depreciation calculation. So the question then becomes, those excess losses, can we use those to offset our other sources of income, meaning W-2 or business income, or are there limitations? So again, if you're under $100,000 and you're not a real estate professional, you could use the up to an additional $25,000 of losses to offset your W-2 or other earned income. Now that there's a calculation, and essentially it phases out at $150,000, meaning if you're not a real estate professional and you make $150,000 or more, then you cannot use real estate losses to offset your current taxable income. Now keep in mind, when we say you can't use it currently, you don't lose those tax benefits. It just gets accumulated and carried forward into the future, some point in the future when you're able to use it. Now the benefit of being a real estate professional is that regardless of your income limit, or regardless of your income amount, there is no limitation in terms of how much real estate losses you can use to offset other earned income. So let's say, for example, you are an attorney, and you made, let's say, $500,000 this year from your business or your job, and your wife is a real estate professional, and let's say you had $500,000 of real estate losses by calculating all the depreciation, the mortgage interest, all of those things. Well, what that means is you can use the entire $500,000 from your real estate to offset the husband's earned income, essentially reducing your taxable income down to zero in this example. Does that make sense?
Yeah, I think that's a good explanation.
Okay.
We're going to call up any other panelists want to add anything? I think that was a pretty thorough. Great. We're going to go to Renee Lewis, who has a question for us. So, Renee, what can the panel answer for you? So, Renee, we kind of hear you. Can you hear us? Okay, we're going to skip over Renee, and if you get your question, feel free to ask it in text form. From Julie, we've got a question from Julie Hendricks. Can the CPA address the advantages versus disadvantages of possibly leasing versus buying a car in 2011 versus 2012? For example, if you have a chance to lease a car before 2011, should I do so?
Okay, yes. So, again, kind of going back to what we talked about earlier, it's going to really depend.
Amanda, we lost your audio for just a second.
Can you guys hear me okay?
Yeah, why don't you start your answer over?
Okay, you can hear me now?
Yeah.
Okay, perfect. So, the answer to that is going to depend upon, the specific taxpayer, but we'll kind of speak generally about this question. So, generally speaking, with respect to 2011, because we do have an opportunity for the bonus depreciation, that's the 100% write-off. If you're looking to purchase a large SUV or truck, meaning over 6,000 pounds, and it's going to be a brand new, meaning not previously owned, and it's going to be used a big percentage, or 90 or 100% for your business, then it may make sense for you to really consider purchasing the car because of that 100% write-off this year. Okay. Now, if you're looking for a luxury automobile, for example, that's not going to be 6,000 pounds and/or it's not brand new, then it really would be important to run the analysis to see, whether the lease will be more beneficial for you in the long run. But I guess, either way, it definitely makes sense to run the numbers. It's not going to be one size fits all. I mean, in addition to the tax benefits, of course, you're also looking at just the cash flow considerations. What's the down payment? Do you have the down payment to put? And also, what's the lease payment that we're talking about?
Excellent. Richard Young asks, and I think this is a good question for Karin, can I lend money from my IRA to my father-in-law so he can use those funds to purchase a family vacation home? Are there any conflicts for the use of this property by myself or family members? Great question, Richard.
It is a great question. Father-in-law is allowed, he's not disallowed, so there's that, but it's a family vacation home, so I would be very careful about that because if it's your IRA lending, you're not allowed to have any personal use of that asset. So you can't go there. You know, you can lend the money, your IRA can lend the money to the father-in-law, but you and your spouse and any of your ascendants and descendants can't have any use. So I think a family asset, you know, family vacation home would not be the best thing, you see.
Yeah, yeah. This is more of a personal preference than an investment to your specific question. But generally, as a strategy consultant, I think you're better off purchasing your assets and leasing your liabilities. So if this is a family vacation home, oftentimes if you took the equivalent amount of dollars and invested it in some type of asset that was focused on creating the maximum yield, and then you took that yield to then go rent your vacation home, I generally, it wasn't the question you were asking, but generally that's kind of my first impression was that even if you could do it, I don't think it's a prudent thing to do. Obviously, if you're an ultra-high net worth individual and you don't need the proceeds of your income, then go buy all the liabilities you want to buy, but it takes it out of the category of investment into just doodads.
And I would add that's such excellent advice. And when I hear the question, it kind of sends up so many red flags because you really need to keep things arm's length when you're dealing with an IRA.
Mm-hmm. Mm-hmm. Any of the other? We've got a question from Van, and Van says, how much can you put into a self-directed IRA in one lump sum?
Well, I can address that. Amanda and Matt can address that too. The answer is it depends. It depends upon the asset. It depends upon the type of IRA that you have. If you have a SEP IRA, if you're self-employed, you have a simplified employment plan, you can put 25% or $49,000, whichever is less. If you have a traditional or a Roth, I mean, your income matters, but you could, put away $5,000 or $6,000 depending on your age. So it depends on your age. It depends on the kind of IRA that you have.
I think that was a good.
Well, and I'll just add a little additional point to that. It also depends on what type of business you have and how you're structured. So the different kinds of plans. So for example, a solo 401k versus a SEP IRA has different tax calculations in terms of how much you can contribute. So that's also another thing to discuss with your tax advisor. If you have a business that's fairly profitable or has been in 2011, it definitely would be worthwhile for you to call your tax advisor and have them run the numbers to talk to you about which type of these self-directed retirement accounts with Karen could give you the most tax contributions this year.
Great. We've got a question from Scott Willoughby who says, when registering an LLC for the first time, does the limited liabilities incorporation start from the time of first registration, filling out the initial paperwork, or from the time when the registration is completed, maybe 6 weeks later? What happens if I file now in December and it takes 6 weeks to complete? Will the LLC be effective this year or next? Let's send that over to Jeff Lerman. And Jeff, we've lost your audio. So Scott, we'll get that answered to you in an email if we can get Jeff's audio back. Unless Michelle, do you have the answer to that question?
I don't. Sorry.
Yeah. Okay, great. So Julie Hendricks asks, if you start a Roth solo 401k for 2011, do you have to fund it in part or in full by the end of the year, by December 31st? If not, when is the deadline for funding it?
I think we should let Amanda take that one.
Okay. So if you have a 401k, and a solo 401k, you have a Roth component. You have all the way up until April 15th of 2012 to fund that for the 2011 year. Now, when you say funded in part or in full, it's really up to you. can fund, depending on your age, up to $5,000 or $6,000 into the Roth bucket of the 401k. And what I love about UDirect, and correct me if I'm wrong, Karin, I believe for you guys, when you set up a self-directed solo K, it comes with the Roth component or the Roth bucket already built in, right?
That's a selection that you have. You can choose to have a Roth bucket or not.
Okay, but it's one in the same. It's one in the same account, right?
Correct. So with the solo K, one account has two parts: an employer part and an employee part, and the employee part can be Roth or pre-tax. Either way, you decide that.
Great. Well, we have definitely had a great conversation today. I'm very grateful to our faculty for donating their time, and I really thank our audience for attending. Without you, there'd be no point to have an event like this. So really grateful for everyone's time being here. If you have any additional questions that you thought of afterwards, you can send them directly to the presenter, or you can send them to me, David at hasslefreecashflowinvesting.com, and I will pass those along to the appropriate presenter. Thank you everyone for attending, and you have a great day.
Thank you.
Thank you. Thank you.